When market volatility strikes a position in your portfolio, you must determine if the price action originated from a Form 8K. Most investors monitor headlines and price charts, but the market frequently processes its first actionable signal directly from the EDGAR database. The 8K is the disclosure instrument public companies use to fulfill reporting obligations for unscheduled material events. This means a significant corporate event has occurred that alters the business's fundamental valuation. Under SEC disclosure requirements, the registrant typically has 4 business days to file. That filing window affects investor trading. The 8K enters the public domain before the data gets consolidated into a 10K or synthesized by the financial press. If you ignore the raw filing, you're trading behind institutional investors who monitor the source document. We're going to decode the specific 8K disclosure items that drive market repricing and what you must analyze first. Unlike periodic reports, the 8K is designed for immediate disclosure when the SEC considers an event material, which often accelerates how quickly the market absorbs new information. So when you're evaluating an 8K, one of the first things to look for is any material definitive agreement. When a company executes a significant contract, like a credit facility, asset disposition, or merger agreement, the valuation impact is immediate. You must look past the summary text. Open the attached exhibit and extract the payment terms, indemnification clauses, termination rights, and liquidity requirements. These specific covenants dictate whether the agreement strengthens the balance sheet or introduces new operational risk. A poorly structured credit facility can severely dilute shareholder equity. A good example is AMC Entertainment's financing deals during 2020 and 2021. On the surface, the filings signaled fresh liquidity at a time when the company needed cash. But when investors looked deeper at the terms, including dilution risk, debt structure, and the company's ongoing capital needs, it became clear those agreements came with major trade-offs for shareholders. The headline was financing. The real story was what that financing meant for future equity value. A good real-world example is Bed Bath & Beyond. In February 2023, the company disclosed a complex financing deal designed to raise cash and avoid a near-term collapse. On the surface, the announcement looked like a lifeline. But once investors worked through the structure, including the preferred securities, conversion mechanics, and dilution risk, the market quickly recognized how damaging the terms could be for common shareholders. The stock fell sharply in the days that followed, because the real story wasn't just new financing, it was the cost of that financing. That's the point. A credit facility or financing agreement can improve short-term survival while still weakening long-term equity value. If you don't read the filing terms, you miss the real risk. Another disclosure that can move a stock is the departure of a director or senior executive under Section 5.02. A resignation on its own doesn't tell the full story, but the language used in the filing is structured for a reason. You must check if the filing indicates a disagreement regarding operations, corporate policy, or accounting practices. If the separation agreement outlines accelerated vesting or unusual severance terms, you must analyze the underlying cause of the departure. A good example is Brixmor Property Group in 2016. After an internal review found that certain financial metrics had been manipulated, the company disclosed the departures of its CEO, CFO, and Chief Accounting Officer. The market didn't treat those exits as routine management changes. Brixmor shares fell about 20% that day because investors interpreted the departures as a signal of broader accounting and governance problems. Another area to watch is disclosures about results of operations and financial condition, which can put new information into the market before the formal 10Q is filed. You must analyze more than top-line revenue or earnings per share. Cross-reference the new figures against the historical data in the prior 10K and verify whether the forward-looking guidance or cash flow metrics have changed. It's also critical to monitor filings that indicate non-reliance on previously issued financial statements or a change in the certifying accountant. This disclosure directly compromises the integrity of the historical data. If the market loses confidence in the audit process, the equity valuation can reset downward immediately. A strong example is Luckin Coffee. After the company disclosed that prior financial statements could no longer be relied upon following an internal investigation into fabricated sales, the stock collapsed within days, wiping out a huge portion of its market value. That's how quickly a non-reliance filing can destroy confidence in the numbers and force the market to reset valuation. Your due diligence process must be established before the next material event occurs. Create free SEC filing alerts for every security in your portfolio and your active watch list. It's free on secfilingdata.com, and it connects you directly to the regulatory source for the filings. When an 8K is published, bypass the cover page and navigate directly to the item numbers. Read the primary disclosure, then open the corresponding exhibit. For a material definitive agreement, Locate the termination clauses and liquidity requirements within the contract. For an executive departure, analyze the precise phrasing of the transition terms. If the filing flags a material weakness or audit issue, evaluate the remediation plan. This methodical approach won't predict every market move, but it grounds your due diligence in verified regulatory data. By reading the filing itself, you can spot that structural risk before the financial press catches up. And if you want those signals faster, sign up for SEC filing alerts at secfilingdata.com. It's a smarter way to stop reacting to charts and start acting on the underlying regulatory facts.